Welcome back. We are into episode 2 of our 5-part mini-series on the top 5 questions you all out there are asking the internet about real estate in 2025. These are top 5 questions you are putting into ChatGPT and putting into Google. They're your burning questions. We did number 1 last week, which is should you buy now or wait in 2025? You can watch that one on the Informed Home Buyer podcast playlist. Today's subject is, are prices crashing? Or I would say, are prices really crashing? And we've got a lot of information and data for you to help support what we're going to tell you about crashing. But I will say, from the 30,000 foot view, what the media is telling you that the sky is falling is not what's being borne out in the data. So we've got some of that to present to you today. And we're going to go through it so you can start to pick the signal from the noise out there and get a good sense of where a price is going to go, how quickly are they going to go there, so you can decide where your entry point might be in the 2025 or beyond real estate market. Welcome back to the Informed Home Buyer podcast. As always, I'm your host, Rich Curtis, and I'm my co-host with me today, Dave Miller. How's it going, Dave?
Good, Rich. Good morning. Thanks for having me.
So here we are again, the perennial question that people have been asking probably since the COVID lockdown, real estate run up insanity. Is it a bubble? Are prices going to crash? I'm going to get into the data in a minute, Dave. But just here in your local market, you're in Folsom. Are you seeing prices crashing down around you in Folsom?
I am not seeing prices crashing down here in Folsom. I think the thing that I'm seeing the most, and we've talked about this on another podcast, is and especially going back the last 30 and 60 days, a lot of houses come on the market and then a lot of houses come off the market.
Yeah,
Not
fluctuating
a lot of,
inventory.
so not a lot of sold signs on a lot of those houses. In fact, on my street, I've seen a couple come up, signs gone, and now tenants have moved in,
Yeah.
renters. And so some of those were already a rental and some were homeowners that, took it off the market and decided to rent out their house. So, um, and I think part of this, and I know you're going to get into the data, but what I really see is, and we've always kind of talked about, is like an accelerated appreciation over the last, how many years? 4 years, really.
Yeah.
Um, and at some point that acceleration stopped. We became flat. But there was many folks that, and especially based on seasonality, they were waiting for the spring and summer selling season. So they held out 60, 90, 120 days. But by the time they listed, that rapid appreciation had flattened out, but they were still continuing to add, 2% to their value of their house over those remaining 2 or 3 months. So now they're 6, 8% higher than what fair market value was. And just
Yeah.
not realistic. They didn't time the market perfectly. And so they felt like they took a loss and they took their, as famous guy once said, they took their ball and went home. So, um,
Yeah, we're seeing so much of that. We're going to present to you some national data, some statewide data, all 52 counties for California, and some local data for our 5 local counties here, so you can get a sense of really what's going on out there. And we're going to show you the way the media is presenting some of the numbers and the actual numbers, so you can start to tell the differences. But that really is the story there. In order for prices to be crashing, we would need inventory to be piling up, just a lot of homes coming on the market and having a lot of unsold inventory, making sellers have to bring down their prices in order to move properties. And with the delisting trend, we're not seeing that. If you're not familiar with the delisting trend that we're talking about, we do have an episode. I'll try to link to it at the end or in the description down below for you on that. But to put into perspective, last month in the little town of Placerville, where I work, we had 7 houses come off the market for every 1 that came on the market last month. The worst in the country, Phoenix, Arizona, had 30 houses come off the market for every 1 that came on the market in July. So this is a big deal where people are coming out. We have another episode you can watch that says, listing, testing prices. People are coming out, they're testing the market. If they don't get what they want, they have a lot of equity, they have a low interest rate, and they say, I'll just stay. I'm not going to lose the money, and I'm not going to eat a higher interest rate and buy a smaller house than I have now for more money if I can't get what I want. And so that is keeping the inventory kind of going up and down, but not stacking up to the point where we'd see massive price reductions. And I think you're going to see that borne out in the data, that are prices coming down? The answer is yes. But I agree with Dave, our price is crashing. No, they're not. So let's see. You want to run some data?
yeah, I think that's great.
All right. You'll have to excuse me some looks to the side, folks. This is way too many numbers to keep track of. But I'm going to share my screen right now to highlight why, if you're watching the nightly news and they're telling you the sky is falling and houses are crashing, which is what I see every night on the news, why that doesn't line up with the numbers. There's a lot of ways to skew these numbers. So we're going to teach you some ways to kind of pick out the signal from the noise here. And so this is a CBS News article where they're talking about price reductions nationwide. The highlighted part here says that the cities that saw the biggest declines in price were Austin, that's Austin, Texas, where median listing prices, put a pin in that, you see it's underlined in blue, have fallen nearly 15% over the last 3 years. And Miami, Florida, where prices have dropped around 19%. Now, here's what's disingenuous about the presentation of the facts here. Highlighted in blue, median listing prices. Listing prices are wishes, hopes, and dreams. They are not comparable sold or property data. Now, according to Realtor.com, Redfin, and Zillow, who's tracking the actual closed sales data, the real number for Austin is off 5.1% year over year. So you have CBS News saying, hey, prices are down 15% in Austin, which they're technically not lying because they're talking about listing prices. But with that delisting trend, a lot of those people are pulling those houses back off the market. They're not becoming closed sales, which means they're not becoming what we call comps, comparable sold properties that we can use to price the next round of properties. And so the actual amount year over year of real estate price reductions in Austin, Texas is only 5.1%, 10% less than CBS is presenting here. Same with Miami, 19%. The Miami numbers are negative 4.7%. They're off 4.7% year over year, even though CBS News just made it look like they're off 19%. That's what makes it so hard to make informed and educated real estate decisions out there right now, is these people are willing to skew the data for the sake of a couple of clicks to make it more salacious and scary than it is. What we try to do on this podcast, like I say, is pick that signal from the noise for you. David, it cracks me up. I saw another one earlier this year where they were trying to make the case it was going to be like 2008, where the default level was way up. And when you zoomed in on the chart, it was the default level on multifamily homes, like apartment buildings.
Oh, yeah. It's definitely skewed there. And, I was just thinking about, the numbers that you were just presenting in Austin. And then I know you're going to present some local numbers here, but I mean, it creates a sense of concern and panic for, local home buyers. If you're thinking about buying and you're like, oh my gosh, it's crashing down 19%. You might be thinking now's not the right time to buy, because what if it drops another 19%, or I'm going to get a bargain deal? None of that really holds true. Obviously you want to get the best price possible. But if a house, we always use a $500,000 purchase price house. If it, went down 5%, $25,000 in a year's time. Okay, that's some significant benefit, but we can't project that that's going to continue to go down year over year, and you're going to wait 2 years, 3 years. We just know based on historically, when things come down a bit, they bounce back up. So not going to time that bottom perfectly either.
Yeah. And if you were using that median of 500,000 and you were off 5%, you lost that 25 grand. But if you were looking at the news and they told you you're off 15%, you think you just lost 75 grand. And people start to either not list because they're like, well, I've lost too much already, I'm going to stay. So that skews the market, or they panic list and they list for lower, which then increases the drops. But either way, the narrative of the media is messing with our confidence-based market with inappropriate numbers. If you and I did that, we actually could get sued for panic peddling, if we were skewing the data like that. But the media can do this with impunity because they don't have a real estate license, So
right.
It's important for you guys at home to dig in. Now, if you're not getting the data from us, or you're not local to us, you can contact a local realtor. They can get it. You can go onto your statewide real estate association. They will have a public facing data portal for your state where you can get these accurate numbers. A little bit of digging into the internet, you can get the accurate numbers. Stay off the headline numbers, because they're going to help you. The headline numbers are going to help you make really poor choices. So let's go. We had some comments on the last one asking to do a little more regional data. So let's go through a couple of the other major metros that are down, and then we'll get into some local data to make this point. So of the 50 largest metro areas in the country, 14 of them are down year over year. Now, again, when you look at the data, right, that is well less than half of them are actually down. The majority of the 50 major metros in the country are actually up year over year. Now, that doesn't paint the same sky is falling, prices are crashing narrative that you're hearing out there. So the ones that are down are, like we said, Austin 5.1%, Tampa, Florida 5.0%, Miami 4.7%, Chicago, Illinois, we're down 4.4%, Los Angeles, California down 4.2%, Denver, Colorado down 4.0%, San Antonio, Texas down 3.7%, Dallas down 3%. Texas looks like it's getting hit a little bit hard here. Phoenix down 2.8%. That doesn't shock me at all with the delistings going on that we talked about. Phoenix with, one house listed for every 30 houses pulled. In fact, I would have expected Phoenix to be posting up worse numbers.
Me too.
To be honest with you.
Very shocked by that.
Orlando down 2.8%. Jacksonville, Florida down 2.7%. So Florida's getting hit pretty hard again. We'll stick a pin in that too. New Orleans down 2.4%, Atlanta down 2.3%, Houston down 1.4%. The rest of the other ones on the 50 major metros in the country list are all up. Some people on some financial sort of guru YouTube channels will be making a big deal about Florida being down because Florida was the first one to crack in the Great Recession. If you remember, Dave, Florida. They got hit before we did, and we got hit pretty hard here in Sacramento.
Right. Yes. I remember watching some shows with people going to some foreclosed houses with alligators running around and some other stuff. So,
and a lot of auctions. Yeah, a lot of auctions
Yes.
in Florida. There was a lot of California investors buying up properties in Florida at the time. But so people are pointing out and saying, look, this is the harbinger. This is the canary in the coal mine. It's crashing again. But we don't have those same mechanics. We don't have a bunch of people with no equity. We don't have a bunch of people with negative amortization loans. We don't have these huge waves of foreclosure coming. So even though Florida is cracking first again, it is not the same crack. We are not going to see those. We were off 40, 60% here in Sacramento in the Great Recession. We're not going to see that again. Right.
Right.
So, and in fact, we're not seeing anywhere close to that. So that's a good segue into our Sacramento numbers. So Sacramento County, we are down, hold on to your hat, only 1.9% year over year in Sacramento. Now remember, in the Great Recession, like Florida, Sacramento was one of the hardest hit in the country. Like I said, 40, 60% down overall. We were 1.9% down year over year. If you go back to one of our podcasts from 6 months ago, where we have Zillow and Redfin saying the whole nation is going to be down 1 to 2% for the year. This falls right in line with that. We have El Dorado County currently up 3% per year. So just kind of chugging along, keeping pace with inflation. We've got Placer County up 2.9% year over year. We've got Amador County posting up negatives at a negative 8.3%. And we've got Nevada County posting up negative 8.2%. So 3 of our 5 local counties are down, but the largest we're down is 8.3%. We are still in single digits. That's hardly crash territory.
Yeah, and I would say the 2 counties that are down the most, Rich, have the fewest number of houses. Is that fair to say? Like they're spread out and
both very rural. Yeah,
very rural.
Very
yeah,
rural.
So the data is going to be skewed a bit more than it would in a Sacramento or Placer County.
Yeah, your big cities in Nevada County going to be, Grass Valley and Nevada City. These are small rural communities. Amador, biggest might be Jackson out there.
Yeah.
And again, real small rural communities. Jackson's a little gold rush town. So, way smaller than Placerville even. So these places that are posting up the bigger losses are more rural locations. I'm most heartened, to be honest with y'all, by the negative 1.9 in Sacramento. That is not a big scary number by any means compared to this type of stuff we were seeing show up in the data in 08, 09 to 2010. This is a really reasonable number given what's going on macroeconomically in the country right now. Wouldn't you say, Dave?
Yes, 100%, very reasonable. And one should expect, I mean, if you keep up with inflation, inflation numbers were higher. We weren't even keeping up with inflation for a bit there. And as the home values, if you come down 1.9%, that's really such just a little blip. What you need to do is track, does that continue to grow year over year? And at what percentage does that continue to grow? Because the other thing we look at, Rich, is what's your alternative? People have to have a place to live. We're talking about shelter. We're talking about, do I own? Do I rent? What are your options, your alternatives? And so if you are stuck as a renter and your rent is going much higher than, year over year, we're seeing still rents increase. You might think about really buying a house now and controlling, your asset where your price now, and we've talked about this, and I know we'll do another podcast on this, the difference between owning versus renting, that margin is getting tighter and tighter as values hold steady, rates tend to tick down just a little bit. That delta is much more narrow, and it's pretty compelling.
Yeah, and I think too, we're looking down the barrel of interest rates starting to come down, not dramatically as we've said, but you were presenting some data offline, Dave. Why don't you share? We've been saying all along we didn't expect a July Fed rate cut, and this all does play into where real estate prices go. So we'll wrap that up for you at the end of the data here, but. We didn't get a reduction in July, but the winds are shifting a little bit with that bad jobs report that came out. So what are the expectations now for the remaining 3 Fed meetings this year in terms of the federal funds rate?
Yeah, and the information that I read in pundits today were saying there's a 90+% chance that we see a rate reduction at the next Fed meeting in September. So, and right now there's a high percentage that's a 25 basis point rate cut. Potentially a 50 basis point rate cut. Some folks are talking about that. They say that's probably sub 50%. But there's also, talk that within the next 3 meetings that we could see a rate cut in each one. They said typically, the information, or folks are saying that typically the hardest rate cut is the first one. Once you pull that trigger. Yeah, and you usually and you have a plan and an expectation that you're going to follow that. So that's why you take little rate cuts, 25%, monitor the data, you're on pace, you do another 25% rate cut.
And 25 basis points, not 25%. Love to see a 25%
25
rate cut.
Yeah. But some folks are saying based on the CPI, the numbers that came out today, the market's already starting to price that in a little bit. There's already an expectation that we're going to see at least 50 basis points reduction by the end of the year minimum.
And again, folks, that's a federal funds rate. When we say 25 basis points, we're talking about a 1/4 percentage point off of the federal funds rate. That is not a 1-to-1 to the mortgage interest rate. But Dave, let's say, just a thought experiment, hypothetical, say we get 3 meetings, nothing drastic. They just keep it conservative, a 1/4 point each meeting. So we get 0.75% off of the federal funds, the short-term lending rate by the end of the year. What could we reasonably expect to see in mortgage interest rate reduction for that by the end of the year?
Yeah, I would say between a 1/4, probably just over just a 1/4 to 3/8 rate reduction, less than half by the end of the year. And some of that's
close to like us. Oh, sorry, go ahead.
And some of that's already been kind of factored in, we're monitoring the bond market. And, if you look at the 10-year note, it's still, holding pretty strong here. But some of that's already been somewhat factored in. So we're now hovering, I want to say we're around, range 6.5, 6 5/8 range on a 30-year for, what we call A paper borrowers, money down, good credit, good income. But I would expect that we are going to see that closer to 6 1/8 to 6 1/4. That's my expectation by the end of the year.
That's pretty good. That's better than we thought 4 months ago.
Yes, for sure. Yes.
Yeah. And so this doesn't have a direct correlation to home prices, right? It doesn't even have a direct correlation to mortgage interest rates, although it helps. But how this factors into home prices is if the Fed is dropping those, doing the Fed rate cuts right now, what we are seeing is inflation isn't really easing. It's staying pretty steady, but it's not where they want it. It's not easing. So they are not making those rate cuts because of inflation getting better. Is that fair to say, Dave?
That is fair to say. I think it's the jobs report with a combination of inflation staying relatively steady right now. It's still above their target of 2%, which they would ideally hold, but the job numbers is what's really causing that motivation with inflation staying in check. The job numbers as part of their dual mandate to focus on employment and the overall inflation numbers.
And that will have an effect on housing prices. So if the economy continues to deteriorate, if the job market continues to deteriorate, which is what will cause them to do continued Fed Fed fund rate cuts, easy for me to say, then that's going to be an indication of economic turmoil and hardship. And that will start to have an effect on home prices, because if people are losing their jobs, they're probably selling off some houses. If more people lose their jobs, more people sell, more listings come to market. And these are actual motivated sellers now. They have to sell to move somewhere for a job, or sell because they can't afford it. Right now, we have a very, I would say, unmotivated seller pool, where if I don't get what I want, I might just pull the listing. And so we're not seeing inventory stack up. If we start seeing the job losses increase, we start seeing pain in the economy, and the Fed starts to drop those fund rates, that's going to be an indication that we might begin to see more inventory come to market. And so it won't be the cuts in the Fed fund rates that cause prices to come down, but it'll be the what caused the Fed to cut the rates that will cause prices to come down. That will be job loss and economic problems in the country. So keep a lookout for that. If you do see the Fed cut all three meetings towards the end of the year, I would say that is an indication that it's likely that inventories could rise and we could see some continued price decreases. But again, not falling off a cliff, not prices crashing.
Yeah, very fair to say. I just don't see a glutton of inventory coming on the market, especially with what are your alternative? What these things, when the levels of unemployment figures, that slows down the buyer pool. So if your job, we talk about the 5 fundamentals, but if your income is in question and your employment likelihood is in question, if you already own a home, you may stay put. You got a low interest rate. You probably bought it at a point in time where it's affordable for you. But if you're thinking about buying a home right now, that's where that buyer pool has stayed flat or even shrunk, is that uncertainty in the economy in terms of employment.
Yeah. And then to your point, you may see a market still frozen like it is now, or fighting for balance, because as the inventory is rising, the buyer pool is contracting. And so we just may still have basically not much sales volume going on. So not posting up a lot of comps with a ton of price reduction. So still a slow march down on prices is our prediction. I think the data we presented bears that out. There are 52 counties in California, and right now a little less than half of them, 24 of those 52, are posting up negative year over year on real estate prices. And they're averaging about 8.6. So there's some big outliers there. Mono County at like negative 34%. And then there's some that are down 0.1%. The average is negative 8.6% out of the 24 that are posting up losses so far. So again, that narrative that you're hearing, that prices are crashing, and people always point to California. They always want to doom and gloom on California. California prices especially are crashing. Well, less than half of our counties are posting up losses at the moment. And we're still like 90% of those counties that are posting up losses are in the single digits. So I think it is a fair narrative to say that prices are coming down, and coming down slowly and reasonably. I do not think it's fair to say that prices are crashing. So to get to last week's video, if your buy now or wait decision is because you think prices are going to crash, you want to pick a different criteria to base your decision on, which we talk about in that video. And I'll link that one at the end for you, because I don't see prices crashing or even massive rate cuts happening in a way that'll move the needle that much for any of you to say, that's my entry point. That's what I'm waiting for. Wouldn't you say, Dave?
Yep, I think that's perfectly well said. That's exactly, the takeaway there. And if you meet the 5 fundamentals, if it's right for you, buy. But if it doesn't feel right, maybe it's next year, maybe it's 2 years down the road. But if you're really on the fence here and you're thinking timing's right, let's start having a conversation now so we get you prepared. And if it does end up being 26 or 27 when you end up buying, it's all good.
Yeah. If you want to check out those 5 real estate fundamentals that make you a good, safe buyer in any market, I'll try to link that video as well. We've got that one on the channel for you. I think this is a good place to wrap it up. This was your number 2. It was in the top 3 of your burning real estate questions. I hope we've answered it. It may not be the most satisfying answer because we're not going with the salacious narrative here. We're just presenting the data. Dave and I would love to see bigger price reductions as well. Frankly, it's good for all of us. It's good for the entire country if housing affordability comes up. So we don't have a dog in the fight and saying prices aren't coming down. We think it's good for everybody if they do come down. They are coming down, but they're not falling off a cliff. They're not crashing. And people who are telling you that are more interested in getting your attention and your clicks and helping you make good real estate decisions. Our goal is to help you make the best real estate decisions you can from the comfort of your couch here on the podcast. So to that end, thanks for watching. Thanks for being with us. We'll see you guys on the next one. I'm Rich Curtis.
I'm Dave Miller. Thanks, Rich.
All right. Thanks, Dave.